One of
And
the other things too is like that top on the top line, the income where it has less gross receipts tax collected. Sometimes, and I've seen this in other financial statements from other firms, they don't have that. They have total collections, and that includes the gross receipts tax. So sometimes when businesses make decisions, they base it based on the total
Like a
patient
gross number.
collections. Yes. And that's a very grave mistake. And why would that be, Eric?
yeah, well, and that's a really good point. When you look at a normal output from QuickBooks, gross receipts tax may be buried. Will be buried. And again, the gross receipts tax, if we're lucky enough to have a nationwide audience, gross receipts tax is a odd tax in the state of New Mexico and the state of Hawaii, where services to some degree are taxed, like a sales tax. Now, when you collect that tax at the time a service is provided, that tax revenue is not your revenue. So if you're looking at those taxes as a below the line, Kelly, to your point, your revenue line looks artificially inflated by a number, and
Right.
it's not an insignificant number. And if a doc's thinking, well, my practice is worth 60% of collections, and I have now inflated my quote unquote collections number by gross receipts tax, I may have now in my mind established a sale price or a value. And again, we're going to do a whole thing on the valuing of a dental practice that gets far more complex than just simply a percentage times revenue. But that's where you're going to get some of your analysis is going to be thrown off if you're working with an income number that is higher than what truly is your income.
Well, and all of these percentages would be skewed.
That's right. That's right.
And many times we see that gross receipts tax treated as an operating expense,
Yep.
which then makes your operating expenses look a little, so the net income, the net result, the bottom line won't change. It's just where it lands.
Yep.
And then how that goes into the calculations for these common sized percentages.
That's right.
That's right. And that's why we do it net of the gross, because really we do it net of the gross receipts tax because it's not our money, it's not the doc's money. So
yeah, and that's standard financial reporting. That's the way it should be done. To Cheryl, to your point, your income is your income. Your income isn't something more, and then you're going to arbitrarily decide what you're going to give the state in terms of a sales tax. No, it's very clear. You're collecting that, and that income does not, those receipts do not belong to you. Yeah. So we want to show that, and we work with that net number after gross receipts.
Yeah. So when we talk about, when doctors do talk about collections here in New Mexico, we have to be careful because we have to take into consideration the reduction for the gross receipts tax. Now, not everything that you collect in your dental practice is subject to gross receipts tax, which is a whole other thing, especially
a webinar for another day.